Discuss the what they are saying. Discuss the accounting treatment of the two factoring. What do you know by factoring? Tell me fast. Any idea?
Receivables discounting, I think.
Yes, receivables are discounting. Okay, receivables are discounting. Okay, there are two types of factoring. Is it with recourse, without recourse? You have any idea about it?
No.
Is it there is a with recourse and without recourse? Okay, without recourse. Fine. We will in this process somewhere it will be there. See, it is there. Is right here. It has been mentioned without recourse. Okay, they will mention with recourse or without recourse. So that's the thing. With recourse. I will explain you. Don't worry about that. Okay. Now what they are saying, Ming has two receivables. That it has factored to a bank, and in return for immediate cash proceeds. See what happens. You will have the receivables. You usually any finance company, anything. You have a receivables. Checks will be there, 10,000. Okay. Now you will approach a bank. Bank will say that depending on the risk. Okay. Depending on the risk, they will decide whether it is a with recourse or without recourse. If the risk is less, is right? If the risk is less, definitely they say that yes, we will recover it. Now, if the risk is high, then they'll say that if we are not recovering, then we will return it back and you have to give back us money. Okay. This is the concept of with recourse and without recourse. Based on the risk, there will be a percentage. Okay. There will be a percentage. Very interesting thing. And it comes somewhere. Okay. Ming has two receivables.
You mean they will discount 100% of the receivables?
Pardon?
You mean they will discount 100% of the receivables if there is no risk?
No. How they will discount? You are a banker. You are a banker.
No, because we discount 80%, up to 80%.
At to 80%, 90%, 80% maximum. Is it?
Yeah.
Nobody will discount. Nobody will give 100 to 100. Okay.
Yeah.
No one in the world.
That's why I was surprised. I thought you're.
No.
You mean 100% of the receivables to be discounted?
No. You didn't listen to me. I said they will charge some percentage.
Okay.
You didn't listen to me. I told they will charge some percentage. Is that they will based on if the risk is high, they will charge more percentage. If the risk is less, they charge less percentage. But ultimately they will charge. Okay. Ultimately they will charge. Fine. Now they have two receivables factored to the bank in immediate cash. Both receivables are due in a long-standing customers which are expected to pay in full and on time. Okay. And Ming has agreed 3 months credit period with both customers. The first receivables is 200. In return for assigning receivables, Ming received how much? 180,000 from the factor. Under the terms of factoring, Ming will not have to repay this amount money. Okay, they don't want to repay this money. Means the factor will recover money and he will take it. Even if the customer does not settle the debt, okay, does not settle the debt, the factoring arrangement is set without recourse. Without recourse means we are not going to pay. This is a little bit we can put it as the definition of the thing. And the terms of the factoring arrangement, Ming the customer will not have to repay this money. Even the customer does not settle the debt. This factoring arrangement is said to be without recourse. The second receivables are what is for 100,000. In return assigning received. Ming received how much? 70,000. Is that from the terms of the factory is that Ming will receive further 5,000 if the customer settles the account on time. Okay, means initially they have given 70,000. If the customer is giving on time, they will get another. He will get another. Means almost 25,000 he will give to the factor. 75,000 he will get. If the customer does not settle the account in accordance with the agreed terms, then the receivable will be reassigned back to Ming, who will oblige to refund the factor with original 70,000. Means if the customer is not settling the account, understand the concept. If the customer is not settling the account, is that what we have to, they will reassign back to me, and me, if customer is not settling, they will give me back, and I have to pay back the money. Is it right? I have to pay back the money. This factoring arrangement is called as with recourse. Required the accounting treatment of the two factoring arrangements. Is right? The first one, first receivables. Okay, first time you are doing this. Okay, first receivables. Okay, how much is the first receivables? How much is the first receivables he is going to get?
200.
Is that how much is the first receivables? The first receivables is going to be, what is the value of the first receivables? The value of the first receivables is 200. Okay, see the thing, how it will work. Understand the concept. Can I go to the solution? It will be better, Svetlana. If you permit it, it is more. Can I go?
Okay.
Okay. Can I go to that? Is it? Can I go to that? Fine. Okay. If you find any difficulty, please let, because it is more theoretical one. That is the reason I am preferring that. Okay. And preferring that. See what happens. These are, see, understand the what happens. See the thing. They have 200,000. Is it right? 200,000. In 200,000, you are transferring the risk. Okay, you are transferring the risk. You are transferring the risk to the factor. Okay, factor will take the amount, will take the things, and he will, how much he will giving you back? 180,000. Okay, he is giving you back how much? 180,000. For them, how much is the amount he is going to receive? He is going to have a 20,000. Now, when you are doing this, what should be the treatment in the financial statements? That is very important. Whether we should de-recognize it, or we should not de-recognize it. That's the only thing. Nothing is there. Okay, nothing is there. We should, and it is only de-recognize. Okay, de-recognize in financial statement, especially statement of financial position. That's the very shortest way and to understand. Okay, when you are transferring the receivables to the factor will take the responsibility of recovering it. Factor will not come back to that. If he is not going to come back to that, there is no problem. Is that you, once it is almost, you have received cash. Is that you have received cash, instead of 200,000 you received 180,000. Okay, fine, you have to de-recognize it. In the second case, what's happening? You are having 100,000. Okay, you are transferring to how much? You are transferring and you are getting back how much? 70,000. If on time you are getting how much additional? 5,000. Okay, is that 5,000? Now if he is not going to pay, then there is a issue. Is that if you are not going to pay, then what you have to do? You have to pay back the amount what we have received to again to the factor. Is that here? This the only thing that is difference is whether we should recognize or we should not recognize. As simple as that. The principle take when we are doing this, and it is very important. I see this is the way. Just I am finding it more easy. The principles at stake with de-recognition or otherwise of receivables is whether under the factoring arrangement the risk and rewards of the ownership pass from wing to factor. Is that the risk and fact is going to be from wing to the factor, whether we are transferring the key risk with regard to receivables is the risk of the bad debts. That is why we are talking what we are talking about, what we are doing. We are discussing our loss allowances. Is that we are discussing the concept is loss allowances with respect to financial asset. With respect to financial asset, loss allowances. Is that if the first arrangement, are you clear about this? The key risk is that the key risk is to receivables. This is the first one. This is the second one. Second point. Okay. Now what it says that if the first arrangement 180 has been received as one-off, non-refundable sum. Okay, this is factoring without recourse for bad debts. Without recourse means done. No, without recourse, no refund, no refunding, no returning amount, nothing is there. What happened? The risk of the debt has clearly passed from the Ming to the factoring. Accordingly, Mint should de-recognize the receivables and they will be expense of how much? 20,000. Is it? There is an expense of how much? 20,000. This is point number 3. This is point number 4. And this is point number 4. Okay. And this is point number 5. Is it okay? Now you very simple. Is it right? We have the principle at stake is with de-recognition receivables under factory. We have to transfer the risk and rewards. If we are transferring the risk and rewards, then it is going to be called as a without recourse. They are getting, see what happening? Debit will be what? Debit will be cash. Okay, debit will be what? Debit will be cash. How much? 180,000. Debit will be what? Debit will be the factoring expenses. How much? 20,000. Credit will be what? Credit will be receivables. They have not mentioned, but if you write this general entry, I will say that it will be preferable. Is it? It will be preferable. Are you clear about this? Is it okay? Very simple. Okay. Is it okay with you?
Yes.
Yeah.
Okay, next. In the second arrangement, the 70,000 is simply a payment of account. You are receiving, is that payment on account? Means on where if it is not settled, terms and conditions will be there. Okay, if it is not settled, terms. This is the first sentence. I will put numbers later. More may be received by Ming, implying that Ming retains there is a reward will be there. Is it right? They say that if a customer pays you on time, it is a reward. The money received are refundable in the event of default and such represents an obligation. Is that the money received or refund? If in the event of default, you have to return it back. Okay. This means that the risk of slow payment and bad debts remains with the Ming, who is liable to pay the money so far received. Means you are not transferring the risk. Risk is with me only. Okay. If he is not going, customers are not paying, then I have to return it back. Despite the passage of legal title, if you have a understanding, there is one concept we have covered: substance over form. Any idea about this? Substance over form. Okay, very important. If it is, see, it is there in the basics. Is it in the basics? If you have the financial accounting FA3, okay, refer this one. Otherwise, work with the study hub. Basics has to be substance over form. Okay, substance over form. Form is nothing but the legal title. Substance is what is the asset you are holding. Is it? What is the legal form you are having on? Despite the passage of a legal title, the receivable should remain recognized in the amount in the accounts of Ming. Despite what happening, we have transferred it, but still it is there in the books of Ming. Okay, in the books of Ming. What happened? You have against the loan, similar that you have taken a loan. Okay, similar to that, you have a 100,000 on which you have taken loan of how much? 70,000. Is that you have taken a loan of 70,000? If it is recovered, you will get 5,000 more. If you have not recovered, you have to refund. Is that you have to refund. Despite the passage of legal, that receivable should remain recognized in the accounts of Ming. In substance, in real, in physical form, okay, Ming borrowed 70,000. In physical form, Ming borrowed 70,000, and this loan should be recognized immediately. This will increase what? Increase the gearing. Is that it will increase the gearing? Are you understanding? Very basic. Now, when you are talking in terms of you have to have a good understanding about gearing ratio. Is it right? What will happen? Debt divided by debt plus equity. Your debt will increase. Your debt is increasing. Your gearing ratio will also increases. Are you clear about this? Again, very simple. One way of putting the concept. Is that one way of putting the concept? We don't have any other alternate. If without recourse means sorry, if it is without recourse means the risk and rewards will be transferred. If it is without recourse, what will happen? You will treat it as a cash, debit expenses, and credit will be receivable. If it is with recourse, is that if it is with recourse, the risk and rewards will not be transferred. There will be a substance. We have to identify the amount which we are going to receive as a loan, and subsequently when if it is settled, if it has been collected, if then we have to de-recognize. But to that they are not giving any information about that what will happen in future. We are not concerned about that. Is it? Then it will be recognized as a loan. Once you are recognizing as a loan, what will happen? The immediate impact is your gearing will increase. Are you clear about this?
Yeah.
Okay?
Yeah.
Fine. Very simple concept. Remember this. It's if it is any difficulty, I will let you know. Okay? This is a simple concept without recourse and with recourse. Now what it says is they have mentioned one question here. Is that? Where is that? Fine. Now case holds. Okay. Case holds equity investments at fair value through profit and loss account. Is it at fair value due to short-term cash flow shortages? Case holds some equity investments. What is the question they are asking? Advise the directors of case as to acceptability of the above accounting treatment. You have to advise to the director. Simplest of the simplest language, at the lowest level you have to explain. That is the reason. The moment they mention advice to the directors, you put A, B as simple as possible. I'm giving you very cautioning advice. Okay. Now, cash holds some equity instruments and carrying amount is how much? 4 million. The terms of the disposal state that case has the right to repurchase the shares at any point on the next 2 years at the fair value on the repurchase date. See, what you have sold some investments for 5 million. Carrying amount is how much? 4 million. The terms of disposal of for the next 4 years, they have the right to next 2 years, sorry. They have to right to repurchase whatever the fair value as on date. Case has not de-recognized the investment because the director believes that repurchase is highly likely. Next. Read once again. Very important, very important. The whole equity at fair value due to short-term flow. Case sold. Keep it. See the thing. Case sold. Sold means you have transferred the rights, transferred the risk and rewards. Okay, risk and the term of equity investment. The terms of disposal state that case has the right but no obligation. Is right? But he has the right but no obligation. Okay, right is there, but there is nothing. There is no condition that I will repurchase. Okay, as the right to repurchase the shares any point over the next 2 years at the fair value on the repurchase date. They have the right. See, they have the right, but no obligation. This word we have to. This word we have to. We have to. We have to be very, very careful. Okay, we have to be very, very carefully. We have to understand. They have the right, but no obligation. Case has not de-recognized the investment because the directors believe that repurchase. See, they believe. Okay, they are believing that the repurchase. Now, two things are there. One, it has been sold. The second thing, they have a right but no obligation. Tomorrow I am not going to purchase it. Then what will happen? What will happen after 2 years of what happened? That is a different case. Okay, that is the different case. That is the reason what we have to do. When there is an obligation, we should not de-recognize. When there is no obligation, we have to de-recognize. Okay, is that when there is a no obligation? When there is an obligation, we have to de-recognize. That I am going to buy it. When there is a obligation, is it right? When there is a obligation to repurchase. When there is an obligation to repurchase, we should not de-recognize. When there is no obligation to repurchase, is it no? That's all. That is the answer in simple terms. When there is no obligation to repurchase, definitely it has been sold and they have a right but no obligation. If that is the case, what we have to do? They have to de-recognize. Is that they have to de-recognize. They have to de-recognize, and what happening? Fair value is going to be 5 million. Okay, carrying amount is going to be how much? I will go to the first. I will explain, then I will go to the explanation. Carrying amount is going to be how much? 4 million. Okay, how much is the profit they are getting? They are getting a profit of 1 million. It has to be recognized through fair value through profit and loss. Okay, it is a short term. Is it right? Another reason is it is a short term cash flow shortages. If it is a short term cash flow shortages, the 1 million profit, is it the 1 million profit should be recognized to whom? Should be recognized to profit and loss account. Now we have to add all the things. Is it right? We have to mention they have transferred the asset. If they have transferred the asset, whether they have transferred the contractual rights or not. Then what IFRS 9 says? IFRS 9 says that if the entity is transferring the asset, it must also transfer the significant risk and rewards of ownership. if the IFRS 9 states that if the entity is transferring a financial asset, risk and reward should be transferred. Okay, is that it has to be transferred. Now, what happened? They are selling the asset. They have sold the asset. When they have sold the asset, disposal. They have disposed of the asset. When they have disposed of the asset, the profit should be recognized. Okay, the profit should be recognized. Now you can have a clear difference. If it is charged, it has to be deducted. If it is recognized, it has to be added. We are not going to say anything. It has to be recognized in profit and loss account. So what are the conditions are they? They say that case is under no obligation to buy back the shares. If there is an obligation, there is a different case. Is it right? Now what will happen when there is no obligation? Definitely whether the prices are increasing or prices are decreasing, the decision will not depend on the increase or decrease in prices. If the prices are decreasing, definitely we are not going to have any coverage on that. Is that if there is no obligation that we are going to repurchase the share at any fixed prices also. Is that, and case does not have any, is not retaining. When they have sold it, what will happen? They have transferred the risk and rewards. Okay, they have transferred the risk and rewards. Now, that is the theoretical point. That is the theoretical point, sorry. Now what is its implication? If when we have sold it, they have earned the profit. Okay, they have earned the profit. They have earned the profit of how much? They earned the profit on the financial asset. First you have to de-recognize it. Then we have to show the profit in the profit and loss account. Okay? The same thing, this much is there, nothing is there. Okay, this much is there. By reading the things also, keep it in mind. Very, very easy, understandable concept which we can score. I'm not saying easy marks, but comfortable marks. There is no easy marks. Okay, it's only a comfortable marks which can use. What it says, see the things. The same thing they have mentioned. An entity has transferred financial asset. If it is, this is the point number 1. Okay, when you are writing it, divide the things, small points. Okay, divide the things, small points. Is that if there is it has to be transferred. If it has transferred the contractual, entity has transferred a financial asset. If it has transferred the contractual right to receive the cash flow of the asset. That's what he has done. They have done a 4 million and they have received a cash of how much? They received a cash of 5 million. Okay? They received a cash. Now, second point. IFRS says that entity has transferred asset. It must evaluate to extent whether we have to know whether they have retained any risk or not. Is a reward. If the entity transfers substantially, point number 3, okay? If the entity transfers substantially all risk and reward, the entity must de-recognize. They must de-recognize the financial assets. Now, when you are de-recognizing financial asset, definitely what will happen? There will be a point of gains or losses. If there is a point of gain losses, it has to be shown in the statement of profit and loss. Is that? It has to be same for. Now what they say, case is under no obligation to buy the shares and therefore protected from decline. There is no obligation. He has the right, but there is no obligation. So he is very safe. He says that tomorrow if things will go if value are decreasing, see, I have sold the asset, I got, see, very simple, is it? Simply you understand in a very general way. I have sold the asset, I got 1 million. Now again I will not buy that asset at a higher price. Is that at a higher price? Nobody will do that, okay? Moreover, case does repurchase the share, this will be at, they will buy at a fair value. Definitely, if things are moving well, the value of the asset will increase. Is that now you have sold it for 5 million, assume the value of this will be 6.5 million. Is that the value will be 6 rather than a prefixed price. There is nothing like that. I will going to buy at 5 million only. Nothing will happen. And therefore, case does not retain the risk and rewards. That is the reason they are not holding risk and reward. The risk and rewards of ownership has been transferred, and as such, she should de-recognize the financial asset. A profit of 1 million should be recognized in the profit and loss account. Is it right? This is point number 6, point number 6, point number 7, and this is point number 8, as well as the last one is point number 9. Is it clear to you? Read once. Is it clear to you? Is it okay?
Yeah.
Fine.
Yeah.
Johanna joined?
No.
You are here, Johanna? Where is that? Yes. What they say. This is little bit different, okay? Jones bought an investment in shares. How much? 40 million plus transaction cost. Is that plus transaction cost? The asset was designated upon initial recognition as a fair value through OCI. At the reporting date, the fair value of the financial asset has risen to how much? 60,000. Is that 60 million? Sorry, $60 million. Shortly after the reporting shortly after the reporting date, it has been sold to how much? It has been sold to $70 million after reporting date. How should, there are two things are there. How should the investment be accounted, and how would be the answer would different if the investment has been classified to measure at FTPL. Now, very simple, one by one, okay? On purchases, okay? On purchases. Step 1, okay? Step 1, on purchases. How much is the value we have to take into consideration? We have to recognize it at what? We have to recognize at fair value plus We have to include transaction cost or not? We have to include transaction cost or not? It is there somewhere in the previously we have done, is it right? We have to include the transaction cost. We have to include the transaction cost, is it? Is it? We have to include the transaction cost. Fair value through, they only said it is they have fair value through OCI. Just expand, don't be like this, okay? Now what is the fair value? Fair value will be 40 million. Transaction cost will be how much? Transaction cost will be 1 million. Total will be 41 million. Okay, total will be 41 million. What is the general entry you will have? This is on purchases. What is the general entry you will have? Debit will be the asset, credit will be the they bought a equity. Is that they recognize the equity through the credit will be the, you can put it as a cash or you put it as a bank, doesn't make any difference. Okay, credit will be now. How much is there? 41 million and 41 million. 3 stages are there. Keep it in mind. 3 stages are there. This is step 1. Okay, this is step 1. Okay, what is the second step? Second step is how much? Second step is they have disposed it off. Is it right? They have at reporting that the fair value of the asset has risen to risen to 60 million. Is it right? We have to remeasure. Is it right? Step 2. Is it right? Step 2. Step 2 is what? Step 2 is we are going to remeasure it. Step 2 is remeasurement. Remeasurement at fair value. Okay, remeasurement at fair value. How much is there at reporting date? At reporting date. Is it right? Now, how much is there? How much is the fair value? Fair value is 60 million. Carrying amount is how much? Carrying amount is 41 million. Okay, how much is the difference? 19 million. Okay, how much is the difference? 90 million. Now what you will write this? Is it what will write? This is the fair value through OCI. This is the gain. Is it right? This is the gain. What will be the general entry? What will be that general entry? Debit will be what? Credit will be what? Credit will be OCI. Okay, credit will be OCI, 19 million. Debit will be?
Yes, sir.
Debit, the asset value is increasing. Is that the debit will be the equity shares. Is that equity shares? Assets. Okay, asset within brackets equity shares. How much? 19 million. Okay, how much? 19 million. Next. Next one. What they say? They are saying that it has to be at reporting date. Is that shortly after it has been sold? Is it right? It has been sold. If it has been sold, you have to de-recognize. See the thing. This is way I think it is better understood if you are putting a timeline like this. Is it right? If you are putting a timeline like this, it makes easy for us to understand also. This is step 3. Is it right? This is step 3. How much? At what rate they have disposed? They have disposed it at They have disposed it at how much? They have, see what is the carrying value is how much? 60 million. Fair value is how much? 60 million. Is that fair value is 60 million. Remeasurement value is how much? See, remeasurement value. Is that remeasurement fair value at disposal date? Is that remeasurement is how much? 70 million. Is that minus fair value at disposal date? Is that fair? Not fair value. Okay, we should take it as a. We have to take it what they have mentioned there. At that reporting there, the day fair value. So fine, fair value at reporting date. Fair value at reporting date. Fair value at reporting date. How much fair value at reporting date? 60 million. Difference is how much? 10 million. Okay, this is going to be the gain. Okay, this is going to be the gain, and it has to be the gain should be fair value through OCI. Okay, are you clear about this? Now you have two things. You have disposed of the asset. Is it? You have the disposed of asset for gain, general entry. Is it right? A general entry for to recognize. Okay, to recognize gain. Is it? To recognize gain. What we are going to say? First, you have to increase the value of the asset. Is it right? Assets within brackets equity shares. Is it 10 million? Is that credit will be OCI? How much? 10 million. Is that then we have disposed it of? Is it on disposal? Is it on disposal? On disposal, what happens? Debit will be cash, credit will be asset. Is it okay with you?
Yes.
Is it fine? Next. Yes, Mariam.
Yes, sir.
Fine. Next. What they have said? How would the answer be different if the investment has been classified to profit and loss account? Is that if an investment has been classified to profit? If the investment is classified into profit and loss account, what we have to do? We should not do anything. We have instead of OCI, we have to instead of OCI, we have a minor modification. Is it right? A minor modification. Is it right? If it is through profit and loss account, what will happen if it is what they say, if it is recognized through profit or loss. Profit or loss. What is the rule? Now you will understand. If it is recognized through profit and loss account, 1 million has to be expensed. Okay, 1 million has to be expensed. Okay, fine. How much initial recognition? Initial recognition is how much? Debit will be the asset at what? At 40 million. Okay, we have to exclude. If recognized to profit and loss account, transaction cost. Is it right? You have to write transaction cost has to be expense. Has to be expense through profit or loss. Okay, through profit and loss. Initial recognition is debit will be asset, credit will be cash. Okay, how much is there? It is 40 million. Now we have to take into consideration the transaction cost. Is it? We have to be transaction cost has to be expense. Has to be expense. How much is there? How much is that? Is it right? debit profit or loss, debit profit or loss, credit will be cash. How much? 1 million. Okay, 1 million. Fine. Now, what will happen? See the thing. You get that? At the remeasure that on after 2 years, is it right? They mention it that what designate through at the reporting date. Is that at the reporting date? How much is there at reporting date? At reporting date, remeasurement. Is it right? Fair value at reporting date. Fair value is how much? Fair value is 60 million. Okay. Gain or loss. Okay. Gain or loss. Is it? Now, what is the fair value is how much? Fair value is 60 million. Carrying amount is how much? Carrying amount is 40 million. Is it? 20 million is the gain. Okay. Gain through profit and loss account. Is that fair value through profit and loss account? Is it? Now what happens? Debit will be the asset, equity, investments. Okay. Equity, investments. Credit will be what? Credit will be profit or loss. Is it? The only difference is that's all. Nothing is there. Only difference is transaction cost. Now, other things will remain almost same. Okay. Other things will remain almost same. At disposal. Is it? At disposal. How much is there? They are receiving how much? At disposal. Their cash is how much? Cash is going to be 70 million. Is it right? Disposal value is how much? The fair value at disposal date. Is it right? Is it right? The fair value at disposal date. How much is there? It is 60 million. Okay. Gain is how much? 10 million. You have to write the journal entry. Nothing is there. Okay. You will say that every time I will say nothing is there. Is that journal entry? How it is there? Debit is the cash, 70 million, and the is it right? They increase the value. Is it right? Debit will the asset. Is that debit will be the asset? Sorry. What is the next one? Credit will be the asset. We have sold. Okay. Credit will be the asset. Equity investments. How much? 60 million. And credit will be the profit or loss. How much? 10 million. Is it okay?
Yeah.
Okay, just write down the things. Okay, this is only just you have to write that it has to be done through profit and loss account, profit or that initially fair if you are recognizing the financial asset through profit and loss account, that transaction cost has to be expensed and it has to be expensed through profit and loss account. Is it? Then initial recognition 40 million, general entry, transaction cost 1 million, general entry. We have at the reporting date fair value. At the reporting date, they have a gain of how much? They have a gain of 20 million. Again, you have to write a general entry. Again, at the time of disposal, 70 million is the cash receipts, 60 million has been the derecognition, and 10 million is the gain. That is also again through profit. Gain through what? Gain through profit or loss. Is it okay?
Yeah.
Okay. No. What they say now? Now, what is it? Are you clear about this? Little bit new topic. Okay, little bit new topic. I'm little bit. I'll say very little bit derivative, deriving the value of the asset. Okay. in globally, if we are working in wealth management, if you are working in equity management, if you are working in stock markets, if you are working in any commodities, anywhere, gold, oil, currency, is it right? These prices will always fluctuate, especially gold, currency, and oil prices. We have to be very cautious. There is a lot of risk, and stock prices also, as a matter of fact, okay, stock prices also, there is a huge risk, and we should be very clear when we are making. Here, the chances of getting returns is also high, the chances of getting losses is also high. This is the highest risk. It is the highest risk which we are going to come across. IFRS 9 says that is a financial instrument with following characteristics. The value changes in response to the change of specified interest rate. Rate of interest changing, the value of the product will change. Take your example, loans. If the rate of interest increases, the demand for loan decreases. If the rate of interest increases, the loans will become more costly, more expensive. Security prices, share prices, commodity prices, any commodity, is there any commodity? That's the reason. If you see during the COVID, what happened? Most of the manufacturing cars, okay, most of the manufacturing units, especially cars, okay, they have shut down the manufacturing process. It took almost 1-2 years to get it back, okay. Commodity prices, foreign exchange rate, index of prices or rates, is a consumer price index, okay, consumer price index, wholesale price index, a credit rating or credit index of similar variables called the underlying. Anything is changing, okay, any security, any condition, economic conditions such as instability is there, immediately see what will happen. See the thing, you in your bank, if you take the branch, what will happen? You will have an electronic kiosk is there. Is that you have where you are talking about currencies will be there. You will see what is the buying and what is the selling. Is that, or it is almost on a what? It is almost on a real-time basis. It is almost on a real-time basis. Fine. That's the reason why we have to be very clear. It requires little or no initial net investment. See the things, how risk we are talking about. It requires little or no initial or to other types of contract to have a similar response to changes in the market condition. It doesn't require little or no investment. As a matter of fact, no. See, in some countries, it is banned. Okay, in some countries, it is illegal. Derivatives are not a legal option. But in some countries, it is a hot case. It is settled not now. It will be settled in the future date, somewhere down the line. Okay, I am buying oil for next 3 months. After 3 months, whatever their thing is there, on that I will take the case. Just revise this. Theory here is very important. First time I am saying, understanding the theoretical concept is very important. A contract to buy or sell a non-financial item. What are the non-financial items? Inventory, property, is only a derivative if it can settle net in cash or any financial asset. Is that you are taking the inventory and you are settling in the cash. is that the buying of a non-financial item, you have to buy a non-financial item and you have to settle in cash. The contract was not entered it for the purpose of receipt or delivery to meet entities' operating requirements. We are not talking about day-to-day business. This was not entered for the purpose. Receipt or delivery of the item, okay? To meet the operating means we are not talking about just a day-to-day basis. It means that day-to-day basis it will not work. IFRS says that a contract to buy and sell non is considered, is it right? Is considered to settle net in cash. See, very simple, is it right? What happens? People are very smart, okay? People, and especially people who are dealing with derivatives. I told you, you are dealing with oil. Okay, you are dealing with oil. I told you, last 2-3 days back, immediately oil prices jumped by $10. Nobody expected. Is that nobody expected? Nobody predicted. But what will happen? Because of that, if you have a contract, is it? If you have a valid contract during that period or during that date, and the contract is on a delivery terms, we will say that whatever the price that exists, that price has to be paid. The seller will gain $10 per barrel and the buyer will pay additional $10. They have agreed to this contract. Is it? They have agreed to this contract. Take an example. They have agreed this contract in the month of 1st June. Is that on 1st June they agreed that we are going to pay whatever the price exists. Automatically what will happen? You have to pay that. The terms of the contract permit either party to settle the contract net. The entity has a practice of settling similar contracts regularly. Day-to-day basis it will be settled. The entity for similar has a practice of taking delivery of the item and quickly selling it in order to benefit from fair value changes. We are not taking it for any other purpose. What we'll buy oil, we'll sell oil. Okay? We buy oil, we'll sell oil. We process it, we will sell it. The non-financial item is readily convertible to cash. You take gold, you can convert it to cash very readily. Foreign exchange, by default it is cash. Oil, it is cash. See, commodities. People will say, any commodity, it is the moment a commodity is nothing but a product which can be traded readily in the market. Is it a product that can be traded readily in the market? Now you can put all the products more or less will be readily available and sold in the market, more or less. If the contract is not derivative, then it is a simple executory contract. Since such contracts are not normally accounted until there is a sale or purchase. We are buying and selling. It is not derivatives. Is that we are buying and selling? It is not derivative. We are buying and selling is at no cost. Another, I will tell you one other example. You are buying a car. Okay, you wish to buy a car. You say that I will buy a car during Ramadan. Now what we'll do? You will say that I am going to pay $1,000 riyals. Is it right? This you are paying right now. This you are paying right now on 8th of October. Now, you will say that I will take the delivery in the month of March, 15th March. Now you have to make sure that whether you are going to pay price what it exists right now or you will pay the price what will exist on the date of execution. Is that on the date of people are they say that yes, I am paying advance and I will fix the price, whatever the price that exists now, that I will pay. Or sometimes what will happen, the dealer will not tell. Dealer will say that I didn't get the consignment. Once I get the consignment, I will tell you the price. Okay, this is the difference between a normal contract and a derivative contract. A conceptual framework defines executory contract as a contract that is equally unperformed. Executory contract means what? Which we are going to execute at some particular point of time. This means that neither party to the contract fulfill any of its obligation. May or may not be. Executory, is it right? Defines a contract that is equally unperformed. Is it right? Here the things will work more specifically. Is it right? Now, what will happen when you are giving an advance? Is it right? Sometimes what will happen? It is a refundable. Sometimes it is non-refundable. Keep these two words into consideration. I will going to elaborate. I will going to link it to the concept as applicable. An example of a contract to pay 10 for every hour that they work. If the employee has not yet worked any hours, then there is no obligation to pay to the employees. Is that they say that to pay employees for every hour that they work. If they work, we will pay. If you are not working, a simple explanation. Executive contracts are not normally recognized in financial statements unless they are onerous. Is that the benefits, cost will be more, benefits will be less. This is what we have covered in previous sessions so many times. Is that in previous sessions so many? In which case a provision is accordance with the IS 37. Just read this one. Right? Have you come across these things previously? Yes or no?
Yeah.
Is it? Yes or no? Fine. There are forward contracts. Forward contract is obliged to buy or sell amount at a specified date, at a specified price, at a specified future date. Price is fixed, date is fixed. Future contracts to buy and sell quantity of a specified underlining item at a specified future date. Future contracts are similar to forward contract. What is the difference? The difference is that future contracts have standard terms and traded on the financial exchange. Whereas this is you have to highlight it. Forward contracts are tailor-made and not traded on the financial exchange. One-to-one basis. Is it right? One-to-one basis. Whereas is that forward contracts are tailor-made and not traded on the financial. These are not traded. Okay, I will write here. These are not traded on financial exchange. Whereas swaps are agreed to exchange payments at a specified intervals over a specified period of time. You will come across interest rate swap. Is that you will say what is there? If you have done financial management, in financial management we covered very little. In advanced financial management we are going to cover extensively. Okay, we will say that what is the borrowing rate? Is that what is the borrowing rate and what is the lending rate? What is the spot rate and what is the future rate? Is it that how much you are going to at what rate we are buying, at what rate we are going to lend it. Or again, we will say what will happen. I will not relate this specifically to that, but if you are taking that borrowing cost, okay, what we'll do, we borrow the money and invest in a short-term investments to make sure that the net interest rate will be reduced. The parties they agree to send that there is a concept of a fixed rate of interest and floating rate of interest payments. Is that fixed rate of payments? And see what this is the concept which is used. Okay, what will happen? You if you take the loan, is it? If you take any loan, is it right? There is a concept of a fixed rate. Because you are taking a loan for almost how many years? You are taking a loan, assume you are taking a housing loan for 20 years. But is it, what will happen if it is, we cannot determine a fixed rate for 20 years. What the usually happen what? You will talking about the floating rate. Every 3 months, the central bank will come with the lending rate. And if there is any changes, usually here in our case it's not happening, but whenever there is a change in the rates, or what will happen, you have to realign the rate of interest. That is the reason. If you take the example of Federal Bank of US, is it right? Federal Bank of US, they are very much concerned about, they will monitor, because any change in the rate of interest, any change of rate of interest will have the impact on what? Will have the impact on foreign currency. It will have the impact on foreign currency. Fine. Next, that is what the fixed rate and floating rate. The options give the holder the right but not the obligation to buy or sell a specified underlying asset. What is the, you have given an option to buy, but there is no condition that you should buy. Is that there? You have the right but no obligation. You have the right to buy but no obligation, and usually it happens in all the derivatives. It happens. What happens? Assume the product price, is it right? The product price is going to be how much? It is going to be 100,000. Fine. Now you are going to order it. Okay, you will say that I am ordering by paying how much? $100. Is that $100? And I am agreed to buy this product after 3 months. Is it? After 3 months at the same rate. Okay, now at the same, or I will say that I will agree to buy after 3 months at whatever the date, future price. Okay, whatever the future price. If the product value is increased by 5,000. 105, is it? It will be increased by 5,000. Okay. How much you have paid advance? You paid advance of how much? 100. Is it? If you are losing, you will lose 100. But if you are buying the product, you are paying 4,900 more. You will see the opportunity cost. You see the opportunity cost. Then you'll say that if it is better to buy or better to leave 100. You have the right but no obligation. Is it? You have that. This is called as an options. Is it? You have the buy or sell a specified product on or before the future date. You have the right but no obligation. Okay, fine. I will say that if you are not buying the product, your $100 is not refundable. Fine. It is better to lose $100 rather than to pay $4,900 more. These are the four different concepts. Okay. Here we are not going to that much in detail, but subsequently we will have its implementation. At the measure, how you are going to measure? On the initial measurement, it will be at fair value. Okay, initial measurements at fair value. The expenses to it will be expense to the profit and loss. At the reporting date, it will be remeasured at the fair value. Any changes will be recognized in profit or loss. Is that? Just keep this very important. Is that how you are going to measure it? Fine. Now, what they have mentioned, see the things. They have given two things. Entity has a reporting date of 30. It enters into an option of 1st January to purchase 10,000 shares in another entity. For how much? 10 per share. The purchase price of each option is $1. Is that the purchase price of one option is the purchase price of each option. Each option. They say that it enters into an option. It enters into an option. To purchase how many shares? To purchase 10,000 shares. Is it right? Is that it enters to purchase 10,000. 10,000 shares into 1. Okay, you have how much? 10,000. What it says on by September 31st, the fair value of each increased to how much? 1.3. Is that? See the thing. Put the timeline. Then only you will understand. You have $1. Is it? And after 3 months, is that what they say? September, October, and after 1 month. Is it right? It has been increased to how much? It has been increased to 1.3. Is that? It has increased to 1. Is that each option increased to 1.3? The increase, what they say in the previous case, they said very clearly. It has to be measured at the fair value, transaction cost to profit and loss account. Any movement in fair value should be recognized in profit and loss account. How much is the difference? The difference is 0.3 times 10,000. We are recording it where we are recording in profit and loss account. Is it clear to you? Is it okay?
Yeah.
On 1st November, the fair value increased to how much? 1.5. The share price is how much? 11.5. Is that? Initial the share price is how much? Initial share price is 10. Is it right? It increased to how much? Increased to 11.5. And exercise the option on first, the shares are classified through profit and loss account. Financial assets should be what they say, it has to be recognized at the fair value. Okay, it has to be recognized at the fair value. How much they say? 10,000 times 11.5. Is that 10,000 times 11.5? Okay, investment at shares at the fair value. What happens? You are paying. How much you are paying? See the things. Is that how much is happening? How much it has been paid? You paid a cash of 10. Is it right? You have purchased it. How much? You have purchased it for 10. Is it right? Next, during the increase, how much it has been increased? It has been increased because of the option. What is the option value? They say that the option value is going to be how much? The option value is going to be 1. Okay, the option value is going to be how much? 1. Means each option is going to be identified as a one. In other words, each share is a one option. Okay, one option. 10,000 plus 3,000. And how much you are going to get the profit on that? It is 3,000. Are you clear about this?
So the fixed price is $1?
How much?
$1 is the fixed price?
No. Share price is how much? Share price is 10. Is it right? Share price is how much? This is the share price. Is it right? This is the option price. Option price plus how much it has been increased? It has increased the fair value of each option. Is it right? The fair value of each option. It increased from 1 to 1.3. Okay, the share value of each option. The option price is how much? The option price is, that is the reason I asked you. Okay, the option price is 1. And how much is the increase? The increase price is 0.3. How many share options are there? 10,000 share options are there. Is that 10,000 shares of what they say? What they are saying? What they are saying on 1st November, the fair value per option increased to how much? 1.5. Is that the share value of each option is increased to 1? The share price on the same day, option price is increased to 1.5, and the share price increased to how much? 11.5. Okay, the option price increased to 1.5. From here, what happens? From here, it has been increased to how much? 1.5. Is it? Now, the share price has increased from how much? The share price has been increased from 10 to 11.5. Okay, it has been increased to 10 to 11.5. What they are saying, go back to this rule. At the reporting date, derivatives are remeasured to fair values. Movement in the fair value are recognized on profit and loss account. On initial recognition, fair value, transaction cost, expense. On the reporting date, they are measuring at fair value. What is the fair value here? This is on the measuring date. Is it right? This is happening on the measuring date. Measuring date will be based on the fair value. Okay, fair value of the share. How much is the fair value of the share? Fair value of the share is how much? 11.5. The fair value of the option is increased by 1.5, and the share price on the same date is how much? 11. Now, what is the investment value? Investment of shares is how much? The value of investments will be how much? The value of the investment is 11.5 into 10,000 shares. Are you clear about this?
Yeah.
How much we have paid? How much we have paid? See now the things. Is it right? How much we are going to see? Options means we are going to buy it. Is it right? They say that it enters into option to purchase one other entity. See, with what they have done, keep it in mind. This is on 39. Okay, this is on 39. They have agreed to purchase this option on when? They agreed to purchase this option on 1st November 2005. Is it? They agreed to purchase this option on when? 1st November 2005. Now I will give it more clear explanation, further, a detailed one. Is that first? What they say, their rule says that on initial recognition, it has to be measured at the fair value. Okay, it has to be measured at a fair value. This is the initial recognition. Is it right? This is the initial recognition. 10,000 shares. Okay, 10,000 shares. Value of the option. We are taking the value of the options only. The purchase price of each option. Is that the purchase price of each option is how much? 10,000. Okay. Now, what happens? Again, we are matching option to option only. Okay, the value of the option has been increased. Is that the value of the option is increased? Definitely, when you have sold it, it is $1. Now what happens? The value of the option has been increased by 0.3. Okay, what on this you got? How much you got a gain? How much you got a gain of how much? 3,000. Okay, is it fine? Now this is happening by 30th September. Okay, this is happening on 30th September. Now, fine. When they have entered, see, when they have entered, sorry, 1/6/2005. Is it? They have entered the 1/6/2005. Fine. Now, what happens on 1st November? We are here. Is it? We are here. On 1st November, what happened? The fair value of the option is increased. Okay, the fair value of the option is increased to how much? 1.5. The fair value of the option is increased to 1. What is the option value? Is 1.5. Share value will be how much? Share value is 11.5. We have entered to purchase in another entity. There is a obligation that we are going to purchase it on 1st of November. Now, when you are going to purchase the shares, what will happen? It will be treated as an asset. Is that? It is treated as an asset. Now, what happens? See the thing, very simple way. How much we are giving? We are giving a cash of how much? We are giving a cash of 10 per share. Is it right? When we are giving a cash of how much? 10 per share. What is the option price? Option price is $1 and the option price is how much? 0.3. Is that? Option price is how much? 1. Now, see the thing. We have entered a option with $1. Okay. It has been increased to how much? 1.3. Is that? It has been increased on 1st November. This happens when this happens. See, this happens when this happens on 1st June 2005. This is happening when 30th September 2005. This is exercise is happening 1st November 2005. At this date, how much is there? The price is how much? Option price is how much? 1.5. Now, what is the share price? The share price is 10. Okay, the share price is 10. It increased from here to here. How much the share price increased? Share price increased by 11.5. Is that? Share price has been increased by 11.5. Okay. Now, when the now you have to segregate. What is the value of the share? Value of the share is 10. Okay. Value of the share is 10. That much you have paid. Okay. That much you have paid in cash. Now, over and above, whatever the price of the options are increasing, is it? Whatever the price, how much it has been increased? 1.3. After reporting date, that's what they said. Is it right? An exercise or option number 1 are classified at fair value. The shares are classified at fair value through profit and loss account. Financial assets are recognized at fair value. So the shares are initially measured at how much? Initially measured at 11.5. Now it has been transferred. Okay. When it has been transferred, you should make it a point that what is the initial recognition value. What is the now as on date when you have agreed it, what will happen? What is the value? as on the date of agreement, the value of the share is how much? 10. But as on the date of delivery, the value of the share is how much? 11.5. Means how much we have made in investments. We have made see, when we have what they say, to purchase the entity shares, they have the obligation. Is it right? They have the obligation that they will purchase the shares. When they have the obligation to purchase the shares on 1st of June, it has to be measured at the fair value. Is that? It has to be measured at the fair value. Every time, whenever it is happening, remeasurement is happening, the remeasurement should be done at the fair value. Any profits should be recognized in the profit and loss account. First, we have taken only the options. We have not taken anything, because we have given that option to them. He has only purchased he has only taken the option. Fine. And in the second case also, is that 30th September also. Is that 30th September also? What happened? He has calculated the gain on the option is nothing but a option, a right to buy. That's all. Don't go beyond that. It is only a right to buy. See, if I am having a right to buy, is it right? If I am having a right to buy, definitely I have agreed for $1. The price of the option is increasing. Is that? The price of the option is increasing. Anything when the price of the option is increasing, whatever the increase in price, it will be a profit for us. Is that? It is similar to an asset, underlying asset. It is an underlying asset. They say that profits are increasing. Definitely, it is going to be accounted in the profit and loss. The first segment is with respect to the option. The second segment is when we are doing it on the when we are allocating. Now we have agreed for one. Is that? We have agreed for one. It has been increased to how much? 0.3. It has again went to how much? 0.5. Now we have agreed for how much? We have agreed. We have given how much? We have given 10,000. Is that? One per option. Is it right? Next, on the options, how much you got the thing? You got the value has been increased. Is that? The value has been increased by how much? 3,000. Is that? The value has been increased by 0.3. Okay. Now the value has been increased by how much? From here to here. From here to here, the value of the option is increased at the rate of 0.20. 0.20. Now we have to specify clearly at each stage how much we have gained. What it says, there is no initial investment. Understand point? There is no initial investment. At this point, there is no initial investment. Is that? There is no initial investment. Is it right? No initial investment in asset. What we are doing, the only investment what we are doing, we are going to make investment in purchase of what? In purchase of options. Is that? Purchase of option only we are paying. Is that? If purchase of option, if you have made an investment, then we should have multiplied 10,000 into 10. Is that? We have made an investment, we have to calculate 10,000. We are not doing anything. No initial investment in assets. We are giving an assurance that we will buy. Okay, we are giving an assurance that we will buy. Similar to that, again I am saying, similar to that we are giving an advance. Is that we are giving an advance? That yes, we are giving an advance.
How we got 2,000?
Pardon?
Can you repeat how we got the 2,000?
Yes. Now what happened? 2000. Is it right? 2000. Initial option price is how much? Initial option price is how much? 1. Okay. Initial option prices is how much? 1. It has been increased to how much? 1.3. Is it right? It has increased to how much? 1.3. This happens when? This happens in 30th September. Are you clear about this?
Yeah.
Is it? This happens on 30th September. Now, when it has been executed on 1st of November. Is it okay? Is it? It has been executed on 1st of November. Now, what happens? On the 1st of November, what is the price it has been there? 0.5, 1.5. What is the difference? What is the difference?
2.
2. Is it? 10,000 options, 0.20. See, if you take in reality, it is not something. If you take into reality, this is what I'm not saying in a simple words we say. In simple words we say it is nothing but the concept of brokerage. It is the concept of a broker. In simple words, okay. What I will do, I will buy a product by paying some option amount. Okay, I will buy if you ask me, the people who are dealing with lands, okay, they will do like this. People gold do like this. People who are talking in terms of oil, they do like this. This is what I'm assuring you, that I will buy you a product. Fine, I will make an offer. I will say I am going to give you $10,000. Fine. The value is 100,000. I will give you 10,000. Now I will look out for the buyers. I will look out for the buyers. And what I will say, I will get the delivery on 1st of November. On the 1st of November, if the prices are increasing, how much I am investing? I am investing 10,000, but I will get a good amount. The price is increasing from 10 to 11.5. Okay, the price is increasing from 10 to 11.5. Almost it is going to be how much? If you take into consideration, you are getting a 5,000. Is that you are getting a almost? What I will do? I will buy the product. I will look out for the buyers. I will sell the product. If you go back again, if you go back in the concept, it has been told the same thing. It has been told the same thing. Is it? The terms of the IFRS says the contract to buy or sell a non-financial item is considered to settle net in cash. Is that your non-financial item you are settling in the cash. Land, is there any non-financial? Is that the terms of the contract permit either party to settle? Is that either party, whoever it is part of the process. That entity has a practice of settling similar contracts. You are doing the business with respect to similar contracts, buying and selling. Similar contracts has a practice of taking, this is very important, taking delivery of the item, is that taking the delivery of the item and quickly selling it in order to benefit from the fair value. This is, if you understand this, you have understand other thing. The entity, what we do, practice of taking delivery of the item and then quickly selling it in order to benefit from changes. Securities also, it happens the same, is it? Securities also happen. I will give you an example, another example I will give so that it will be more clear for you. Okay? More clear for you. Most of the time, what will happen, you will come across IPOs, initial public offer. Okay? You have to give you have to pay application fee. Is it? Then there is an allotment. Okay? There is application fee, and after that what will happen, it will be allotment. Application fee is how much? Application fee, assume application fee is going to be 200 paisa. Okay, 200 paisa. The share price is how much? The share price is, we will say that the value of the share is 1 riyal. Okay, the value of the share is value of 100 paisa. Okay, now what happens, you are paying how much? 200 paisa. Okay, at the time of allotment, people will look forward it. Is that people will look for it is a oversubscription. Is that oversubscription? When there is oversubscription, what will happen? The listing price will be more. Is that? The listing price on the stock exchange will be higher. What people will do? People are doing same thing. They will pay for application fee. They will say that as I am going to have 10,000 shares. On the day of allotment, whenever there is an oversubscription, the price of the share will shoot up. The price of the share will shoot up. What people will do? On the first day only they will sell the shares. Is that? On the first day only they will sell the shares. The moment they are selling the shares, they will earn the profit. They are investing money technically, they are not investing any money. Is that? They are not investing, what they say, in that it has been clearly mentioned. Keep it in mind. I will go with the same words. Is it? I will go with the same words. What they say, it requires little or no initial investment. Clearly mentioned. It requires little or no net investments. How much you are just paying for the application. Okay, you are just paying for the application. 100 paisa application. Okay, 100 paisa. One share application is 100 paisa. You pay 100 paisa. You are investing how much? 10,000 shares. Fine. If you take into consideration 10,000 into 100 paisa, how much? It comes to 1,000. Is that your 10? Okay. Now what you are doing? Little investment. 10,000 value of shares. You are buying it for 1,000. At the date of allotment, the value of the share increased to 220. Automatically, what will happen? You are making small investment, but you are getting huge returns. This is the concept of derivatives. In simple words, you are making a small investment, but getting the high return. Risk is very, very, very high. You are estimating that there will be oversubscription, but sometimes not happen. You are expecting that the prices will increase. Sometimes it will not happen. Then there is a possibility of losing also. Underlying asset. What is your underlying asset? The underlying asset is the... Pardon? The underlying asset is the equity share. Are you clear? Now you understand. Is it? You are how much you are paying? Now it will be more clear. You are paying $1 for each option. The value of the option increased to 1.3. The value of the option further increased to 1.5. Okay? Value of option. You are talking at the date of allotment. You will treat it. You are going to pay cash or for the shares. At the date of allotment, you will pay on 1st November. You will pay 10. What is the agreed price? The agreed price is you are going to pay at the rate of 10. This is the agreed price. Is that? This is the agreed price that we are paying on the 10. Now, whatever on the options, how much it has been there, on the options value it is 13,000. It has been increased, is it right? And how much we are taking that at the date of allotment, how much is there? It is going to be 1.5. That is nothing but you are getting a gain on the option. Fine. Is it clear?
Yeah.
1 minute. We will do this question, okay? It will do this question. It will give some understanding, okay? It will give some more understanding for us. Hogarth buys 100 options when January 1, 2006. How many options are there? 100 options. How much price per option is right? Very clearly, price per option is how much? 5. Okay, price per option is how much? What is the option? Gives order to buy a share in rolling on 31st December. This is when? This is 2006. Okay, on 31st December 2006. They are going to buy the shares at how much? At 10 per share. Is it? No. They see, each option gives Hogarth to buy a share in rolling on 31st December, whatever the price is there, how much they are going to pay? They will pay only 10 per dollar, 10 per share. Okay? Whatever the price is there, fine. Whatever the price is there, is that fine? Now, first, how much you are paying? You are paying $5 per option. You are going to pay only option price. That's all. Okay? You are going to pay only the option price. Is it right? Now, first, what you have to do is first what we have purchase of option. Is it right? Purchase of option. Is it right? Option. Fine. Option. What we have to do? It is an asset. Is it underlying asset? Is it? It is an underlying asset. Is that asset within brackets option? 100 into how much? 100 times 5. Okay, 500. You are paying cash. That's all. Okay, this is what happened. Fine. Now, what's happening on? Is that this you are on 1st July? Okay, on 1st July 2006. Okay, how much the price has been increased? Price has been increased to how much? 15. Okay, price has been increased to how much? 15. What they say? They have sold. Options are sold on 1st July. Options have been sold on 1st. They have sold it on 1st July. When they have sold it for, see the thing, they have purchased for how much? They have purchased the option only. They purchased the option for 500. They have sold it for 15. Is it right? They have purchased how much? 500. They have sold it to how much? 15. When you have sold it, is it right? What will happen? You have the cash. Is that you have the cash? How many options are there? 100 options times $15. Is it 100 options $15? How much you got it? You got it a cash of how much? 50. Is it? You got it cash of. Now, how many here we have, when you have purchased the options, it is debit. When you have sold the options, is it? Options sold. Is it right? Here the option purchased. Is it? Option sold. How much you have sold the option? The same price. Now, what's happening? During the time you have sold it for 15. What is the difference? Difference of 1000 at fair value is a difference of 1000 at fair value. It is nothing but profit. How much? 1000. Is it clear to you? Is it okay?
Yes, sir.
Now, you see the things. You find it more interesting. How much you have bought it? They have bought it 5. On December 1st, the share price has been decreased to how much? 8. Is that? Actually, the share price is how much? 10. It has been decreased to how much? It has been decreased to 8. When it has been decreased to 8 and you have let the option is not exercised, unexercised. You have not exercised the option. Is it right? You have not exercised the option. If you have not exercised the option, what will happen? You will have a loss. Is it? You will have a loss. Is it? Not exercised. Not exercised. Is it? Not exercised. What will happen? If you have not exercised, what will happen? There will be a loss. Loss of what? Loss of the option value only. Is it? Loss of the option value only. When there is a loss of option, how much is the option value? We have initially recognized. How much is the option value? 500. Is it? How much is the option value? 500. What will happen? Debit will be profit or loss. Credit will be the option asset. How much is there? You have not exercised 500. Is it? You have not exercised. How much? It is 500. Are you clear about this? If it is not exercised, we are losing only the value how much we have paid. Are you clear about this?
Yes, sir.
Point number C. Option is exercised on when? 31st December. Rowing. Share price is how much? 25. Share price is how much? 25. How many shares they have bought it? They bought it 100 options. Is it right? Now, what will happen? They have exercised at the what is the price? See the thing. How much they will earn? Okay. How much they will earn? How much is they when exercised? When exercised at the share price. At share price is how much? At share price of 25. 100 options. Is it? What will happen? Definitely you own it. Okay. You own it. How much is there? Debit will be the asset. Okay. Debit will be the asset. 100 times 25. It comes to how much? 2,500. Is it? 2,500. How much we have? See. How much we have paid? We have to pay. We have to see. Rowing share 31st December. How much you have to pay? We are getting the value of 25, but we have agreed how much? We have agreed to pay cash of how much? 100 times 10. It comes to how much? 1,000. Is it right? It comes to how much? 1,000. We have agreed, we have paid option price also. How much is the option price? We have paid an option price of how much? 500. Is that? We have paid an option of how much? 500 in the beginning, step 1. Okay. Next. So, is that? Next. What is the difference? The difference is profit or loss. How much is profit and loss? 1,000. If now you are, this is the one example which gives you a complete understanding. Is it a simple way? You have paid an advance. Okay, you are paid an advance. Fine. Now at the time of delivery, you will judge whether it is worth to continue or not. Non-refundable. Is that non-refundable? If you have not exercised the option, you will lose that amount which you have paid to purchase the option. Right to buy, but no obligation. Right to buy, but no obligation. Now, if the values are increasing, it will be attractive to you. See, you have made $10. We agreed to buy $10 share. Value is 25. You will gain. But if you are buying a $10 share, the value is decreasing below 10. Is that value is decreasing below to the 8? Why we will buy the share? Why there is no point of buying the share? What you will say? I will not going to take this option. When you are not going to take that option, it is a non-refundable. Unexercised amount will be treated as a loss. Is it clear to you?
Yeah.
Fine.
Yes.